Hello and welcome to this Diwali special. Let's start by wishing all of our viewers a very, very happy Diwali. Happy festivities. It's been a phenomenal year for the market. A lot of wealth has been generated, not just over the last somewhat, but in the past couple of years as well. Today on this special, we are coming to you from the National Stock Exchange. There's plenty to talk about, plenty to reflect. And apart from discussing the market here and now, the current setup, we have a very special panel joining in because we today want to get into the minds of these stock pickers. They're no strangers to the street. They've been around. They have had a lot of success in some of the themes and some of the bets that they have gone with. So today, we want to know their secret. I'm Surabhi Upadhyay, and with me on the show is Manglam Mallu. Hi, Manglam.
Hi, and you're talking about us wanting to know their secret.
Oh, yes.
You know, the one who really want to know their secrets a lot more are the young.
Yep.
Why do I say that? Because the show is called the Young Guns of D Street. Now, there are three major reasons why. Young in the stock market is a relative term. These guys with an average experience of almost 20 years in the market, they look not like that, but
they're heavyweights,
they're heavyweights,
yes, exactly.
Serious heavyweights, and you'll know that with the assets under management and the kind of wealth that they've created for themselves and all the investors, etc. as well. But the more important part, and this is the analytical aspect of this, every time all of these people joined us on our channels, the kind of response that we got, we went through that, and the cohort that they resonated with the most were the young guns of D Street. So we have the young guns of D Street helping the young guns of D Street who are looking at this Diwali as an opportunity to perhaps, one, clean their houses, their portfolios, and also make a fair amount of wealth.
And one more thing, when you talk about young and youth, the one thing that you usually associate with that is energy, pace, and doing things quickly and perhaps ahead of the curve. That is what our five panelists have mastered. Picking themes early, being ahead of the curve, and riding it towards the road to riches. So we've got plenty to talk about. Stay glued to your screens because, we're just getting started. So, Manglam, let's start by introducing ladies first as always.
Ladies first as always. Not about the age, it's about the attitude. And we have with us Rashi Talwar Bhatia. She joins us. She is the India head of Ashmore, manages the India Long Only Fund, has over 20 years of experience in the market. A young gun that we have from D Street today. Joining us also is Roshi Jain, who is a senior fund manager at HDFC AMC. Total assets under management of the funds that she manages almost 1 lakh crores. But apart from wealth that she's managing and creating, what stood out was her academic achievement as well. An IIM Ahmedabad graduate, also an All India rank holder in chartered accountancy, and a CFA charter holder. So a fair amount of education that went into what after which was a stellar, more than 19-year career in the equity markets.
Now let me come to the gentleman. Well, joining us is Ravi Dharamshi. He, of course, needs no introduction. He's no stranger to the markets. Been there, done that. It's sort of been in the family, but he has taken Value Quest to newer levels. If you look at the performance of the PMS as well, on a steady state basis, we're talking 22, 23 kind of % returns over long periods of time, 5 years, 10 years, consistently beating the benchmark. He's very well known for some early bets in pharmaceuticals, in EMS, and we want to know a lot more about that as we go forward. So Ravi, welcome to the show. Right next to him is Amit Jeswani. Now, if you've been following us, especially on Closing Bell, you would know that here's a man who's, almost picked every single stock that has skyrocketed over the last 12 months. So, hear this, 96% return on the fund in the last 1 year. The question is, how do you pick these winners and how do you ensure that, you pick winners that can last you through cycles as well? So that's what we'll discuss with Amit. Welcome to the show. And then, of course, we have Vikas Khemani, the man who told us to stay, connected and have the faith during the worst of the COVID boom. I remember conversations with Vikas. He was saying, Atmanirbharta, China plus one, this is going to become so big. Right now, the market is falling like a knife, but you've got to have the conviction and go out and look at those bets. And we want to know more about that. He's been celebrated. Of course, his fund, Carnelian, has done really well over the last couple of years. And we will dive deeper into that thought process as we go forward. So, ladies and gentlemen, welcome to the show. It's great to have you here.
Thank you.
Well, let's start with Vikas first, largely because obviously he's no stranger to the ways the market works and the kind of wealth creation that he's done. He's been early on a lot of the themes that we're only now talking about. But Vikas, apart from all of that, you also believe in the long term. Mostly, always. Why do I say that? Because you're also a marathoner. You run so much, so it's in your mind. When you think of investments as a process, how would you define your investing process?
I think, as you rightly said, Mangalam, that first of all, I think wishing you and your viewers happy Diwali and New Year. As you rightly said, that investing is a long-term game. You are buying businesses from long-term perspective and thereby looking to create wealth. So hence, it's very important to have that mindset. And I believe that my biggest winners, my biggest success have come where I've stayed invested for 5, 10, 15 years. And that is where the compounding kicks in. And that, of course, the fact that since you're looking for long-term, you got to do your work really deep because, you are preparing yourself from a very long-term. You can't really do shallow work and then take that perspective, right? So quality and, quality of the management and quality of the business is very, very important before you sort of invest into it. But one, specific thing which has really, really worked for me over the years, if you want to make superior return, supernormal return, you have to always focus on rate of change or what is changing, which is not, something is changing, but the common narrative is something else. And if you are able to figure out something ahead of time, ahead of common narrative, then I think, it gives you a superior advantage, from an entry point of view, and then staying through the very long time as and when more and more people figure it out, right? So I think those are the things which has really, really worked for me. And, whether picking ICICI Bank in 2019, which has become 5x in last, sort of 5 years, when nobody was looking at. I remember when we bought, most people had 0 holding or 1% holding, and everybody's top holdings were something else. So but that really required a really deep perspective, different work. Or like Surbhi was mentioning that, I remember when we launched our manufacturing fund in October 2020.
Yeah.
We could see a lot from connecting to the ground, talking to the companies, saying that something is changing on the ground. But the common narrative was that India can never beat China and Vietnam in manufacturing, Bangladesh is ahead of us. That was a common narrative. But what market and most people were missing was rate of change, what was changing. World is neither utopia nor dystopia, right? Somewhere in between. But what if we are able to find that rate of change which is positive and accelerated, then you can really make supernormal return. The strategy which you were referring to, last 4 years have delivered 47% IRR, right? Which is, I think, beating the benchmark by 20%. Yeah. So I think, of course, you cannot compromise on the quality of the management, quality of the business, because that is where the biggest risk comes also from. So, but that's, I think, probably, if you ask me, most people do it and should be doing that. But I think real edge, according to me, lies in noticing, taking ahead of the curve, and that happens all the time. It's not like it happens once in a while. It happens at the company level, it happens at the industry level, and all the time things keep changing. So we focus a lot on figuring out those trends ahead of the curve, ahead of the time, and that requires a little deeper work.
So look for change. I think that's the first piece of advice that we've got from our panel, and look for change ahead of the curve. That's the first step to sort of looking at major wealth creation. And I'm so glad you mentioned ICICI Bank, because I'm going to come back to the story. We have a segment which is going to be on stock stories. That's what our viewers want to really hear. So I urge all of you to think of one example from your 20, 25-year investing career, one story to narrate. Amit, and your story is going to be trend. I'm going to ask you about that, but later in the stock segment. Right now, we want to really understand what drives you, this whole hunger for growth, because you buy growth businesses, and a lot of them have been on the consumer discretionary side, right? And I remember one conversation where you said, PE is fine, but we don't let PE hold us down. Elaborate on that point. What do you mean by that?
So, the first look, thank you so much, Surbhi and Mangalam, for getting me on this show, and happy Diwali to everyone. So we don't start by PE. That's the thing that I was trying to say. For us, the first most important thing is what is the quality of business. Then we go to growth, because what will I do with a great quality business which is growing at 1%?
HUL in the last quarter? Sorry.
Yeah.
Okay. No names.
Like example, you spoke about HUL. Yeah. Since you're speaking about, but in FMCG criteria, we have stocks like Varun Beverages. While HUL was growing at 1%, Nestle probably this quarter was weak at 2%, but last 3 years being grown at 7-8%. All Godrej, Consumer, other players have grown at single-digit kind of growth. You had one player who was scaling, reinvesting capital at very high ROCs of 27%. That is Varun Beverages, and it was one of the top 4-5 stocks in our portfolio. That when everyone was struggling, this guy, because of Sting initially, was growing at 40-50%, and they also acquired the entire Indian market. So what I'm saying, in every industry, There is one guy who's scaling like there is no, like this quarter. If you see the entire QSR space, the numbers are horrible, a horror show. But you have on one side Zomato, who's scaling at 68%. You want to see, we see India in 71 industries. And in those 71 industries, like probably Trent, you spoke about Trent. This quarter Shoppers Stop grew at 7%. Last quarter Shoppers Stop growth was minus 4%. Last quarter when Shoppers Stop was minus 4, Trent was 58%. It's just telling you that who's executing. In every industry, there are players who are executing, and then players who are telling, "Arey, ye problem hai, that problem hai." Who wants to listen to their problems? You want to bet till the time they are doing well. Like we had DMart. To be honest, we had DMart from first day, first show. And we sold our DMart at 4,200 to get our Trent at 1,200. Because DMart slowed below 20%. And if you don't grow in India at 20%, then it's very tough to us, to be in our portfolio. So we are always chasing good quality companies. In fact, our portfolio beta is 0.8 against Nifty 50 since inception for 6 years. So it's not like we're taking high risk. There's a wrong notion that growth gives you risk. Bad execution gives you bigger risk. Then like higher P multiple.
So I've got the mantra: growth, and growth, but with good quality.
Good quality.
With good quality.
Yeah, the best company in that sector. You don't buy the 10th best company, even if it's growing.
Market leadership,
so
good
the
quality.
two pillars that we've got, or as the young would call it, the quick hacks that we have right now. One of them is
look for change,
and secondly is go for growth and
with
quality, with high quality. Let's go across to Ravi then. Ravi, so many themes that you've identified. How do you identify these themes? I mean, what is the internal drivers that you put in place for you to be able to identify those themes, and what are you looking at right now?
And for the benefit of our viewers, I just want to sort of put the context there.
Yes.
Whether it's pharma, because you were one of the very early sort of persons, and you look at research in a big way. Whether it's pharma, whether it's EMS, or whether it's energy transition, these are some of the themes that Ravi has been very, very optimistic on. So exactly, going back to the question, how do you identify them?
Thank you, Surbhi. Thank you, Mangalam, for having me on the show, and happy Diwali to all. So I guess some variants of what Vikas and Amit just mentioned. Essentially, we are looking for, besides just looking for companies to invest in, first our starting point is looking for where to fish in the pond. I mean, identifying a pond that is growing, and then of course you want to catch the biggest fish. But where where in the pond you go to fish is what we look for. So our starting point is usually, which way the regulatory wind is blowing, which way the consumer behavior is shifting, where is the capital flowing, where is the technology evolving, where the cost curves are hitting the inflection points. Those are the leading indicators that we look for to understand which are the trends that are going to unfold over the next 10, 20, 30 years. However, those 10, 20, 30 years, I mean, it's good to say that I want to invest in this theme for 20 years, but it doesn't happen that way. You have to still break it down into a bite-sized 5-year investment horizon, because it's in that 5-year investment horizon that you have to make money. And a theme, for example, let's say energy transition, it's a large theme. And it comprises of 10 different subsectors within that. It's not like every sector is going to do well. You still need to do your sector picking within that, and then of course identify leaders within that. So our process is a combination of top-down and bottom-up approach, and we first start with the top-down and identifying the themes where the tailwinds are very, very strong, and then come to the picking stocks.
Right. Just to you, Roshi, you operate under the fund mechanism where every fund that there is has its own objective, has its own risk-return ratios, has its own criteria, so to say. In that, what would you say is your individual style?
So thank you for having me, and let me start by wishing all your viewers a very joyous festive season. You're right. I think under the mutual fund umbrella, each fund has its own mandate. And I think one thing that perhaps is critical under the mutual fund umbrella is to stick to that mandate and not be swayed by what happens to be flavors of the season. Each post the SEBI recategorization of funds under different categories, I think that's perhaps one of the key learnings now imposed by the regulator that one needs to be true to label. And while that is a broad, one is of course sticking to the mandate, but I think the other important reason why mutual funds have also scaled up so significantly is also following an investment framework consistently. I think that perhaps less credit is given to mutual funds for that, but you will find that most mutual funds have an investment framework philosophy which is very well married with a risk management philosophy, which we perhaps tend to underestimate, and that's, I think, the key reason why we've seen this kind of scalability in the mutual fund space. Retail flows have come because of the trust, and the trust has been built because of following an investment framework, process, and a risk management framework.
You raised a very important point, Rashi, and I also track personal finance aside from markets as a whole. And I want to come back to that. How easy or difficult is it to maneuver a fund which is 65,000 crore rupees, right? Or bigger funds which could be even bigger. So we'll come back to that, whether that's restrictive or how you sort of ensure the best outcomes. But before we take our first break, we want to know more about Rashi as well. Rashi is at Ashmore. So what's your personal investment philosophy and style, and how would you say that? Does it exactly mirror and replicate Ashmore? Differences, variants, similarities?
So thank you so much. Thank you guys for having me here. And slightly controversial or different from what we've heard from the rest of the panel.
That's great. Divergence of opinion makes the market.
The underlying fundamental that me and my team work with is that markets are not efficient. Right?
Okay.
And markets provide us opportunities where there's price dislocation or mispricing at various points of time. Markets swing from exuberance to pessimism, and we see that at all points of time. And at both ways, the pendulum swings to extremes. What we try to do at Ashmore India is to essentially find those opportunities in the market. So we run a market cap agnostic, benchmark agnostic, high conviction, bottom-up stock portfolio, where we're really looking for good businesses that are possibly going through a difficult time, maybe because something's happened in the company, something's happened in the sector, and there's a significant price dislocation. So the stock price is well below what we believe is the intrinsic value of the stock, giving us the opportunity to buy the stock. So if you look at my portfolio, we will typically not fall into either growth or value, which is why I said we're kind of different. But our contribution to risk return falls into what is squarely known as stock idiosyncratic or stock alpha. And that's what we do.
Right. This is absolutely beautiful because I can see a polar opposite to what Amit just said, which is why it's so good to have all of you on the same panel, because investors can figure out that the road to riches could be sort of varied, the paths could be multiple, but the end objective can still be significant gains.
Absolutely. So what we'll do is we'll just recap the quick 5 hacks that we got from all of them and take a short break, come back, continue our conversation. Vikas Khemani said look for change. Amit said look for growth. He said look where to look. That's most important. That's what Ravi said. Have an investment framework is what Rashi said, and then Rashi wrapped it up beautifully by saying look for price dislocations. Take a short break, come back, chew on that while we discuss a lot more on the other side. Welcome back. You're watching us here on this very special conversation that we're having with the young guns of the street, gentlemen and ladies who are known to identify themes young and then watch them grow their portfolios and grow the portfolio investments of all those who have invested with them. We have Vikas, Amit, Ravi and Rashi with us as well. Amit, we're talking about individual stock journeys. The one that is blown everyone's minds over the last 2 or 3 years is Trent. The way they captured everyone's imagination with Zudio. Earlier, it was feared to be margin dilutive to their West Side business, and now suddenly that's become the growth driver. It's all the way everyone is now betting on the lab-grown piece as well. How did you identify Trent, and when did you decide to, enter? What exactly was the story like?
So Mangalam, we're just looking at every company possible. Like we don't miss out all 4,000-5,000 companies. We don't miss out even one quarterly result. That's the first basic thing that we do. We keep looking and we divide industries, that who's in every industry, who's that player, who's the rock star of that industry. We had pain, and we have a 25 stock portfolio. So there is always 5-7 stocks in my portfolio who are struggling. Like today I'm struggling in a airline company. I'm cutting some weight, down 20%, but it's okay. I'm buying something else 20% down. Everything is down 20% now. So if you're cutting something, you're also buying something down. You want at any point of time your portfolio to be the best performing companies. And you need visibility. See, I don't have a 10-year visibility. I have maximum 4 to 6 quarters of visibility. And I am only thinking, for me, terminal value is 6-8 quarters. Like, of course, I think about, because we buy market leaders and beyond. But we think that beyond that rate of... It's
exact opposite to the person on your left.
No, of course. Right? We think long-term, short-term, medium-term, everything.
All
because if
so he's a sprinter, jumper, and a marathoner. please tell us.
See, that's why we buy a D-Mart. You can have D-Mart for 20 years also. You can have D-Mart for 6 quarters also. But so we keep looking at options and available options, because we have to invest. And Trent.
Yeah.
We initially bought Trent pre-COVID, to be honest, at 600 rupees.
What did you see there?
That time we were seeing West Side had the highest like-to-like growth.
Okay.
We didn't know Zudio will come.
Yeah.
And then COVID happened. We sold Trent. We lost 20% and we bought some pharma stock.
Okay.
We made money in the pharma stock. I'm telling you the real story. Because we made money we were buying Dr. Lal and Metropolis, because we could see tailwinds in Metropolis and Dr. Lal that time in COVID, and we couldn't see when the malls opened.
Yeah.
From 600, we bought Trent again at 1200 after 2-3 years. So we are unemotional towards our investments. We are just thinking that what next is going to have those tailwinds of high growth. We were selling D-Mart, emotional less. It was my first holding. It was the only stock we've held for 5 years in the fund.
You know, I would like to be on the road with him once, and when there are like those toll booths, there are 5 or 6 of them, I will ensure that his car is the one which goes through that toll booth first, or those airport queues as well, because he's just the one who's...
No, I think that's another very, very important lesson, being emotionless. Not letting your ego get in the way, or your attachment with one stock. Oh, I saw this story and I will see it through the end. So I think having a little bit of disengagement at a level, I think, is also important. So we've taken that point on board. Now I want to come to Ravi. And Ravi, you made a really important point, right? So today, like if you ask me, it's a no-brainer. Of course, you have to be in stocks which are in renewables. Obviously, you have to play energy transition. Of course, you want to be in the semiconductor space. But that doesn't make me Ravi Dharamshi, right? The magic is in picking the companies within that space. So then explain to us, how do you do it? I mean, whether it was HAL in defense, whether you picked Hitachi, I think, to play this whole energy space. What goes into the tier 2, tier 3 filtering?
No, so let me just spend a couple of minutes explaining why energy transition. It's not like energy transition came about today. Humans have been going from one source of energy to another source of energy over a period of time. But this is the first time that we are moving away from all our sources of energy have been natural till now. We dig ground or we burn gas or whatever it is. But this is the first time that we are moving towards a manufactured source. Essentially, energy will be, of course, we are catching the energy from either from wind or from solar. But the industry that will benefit is the manufacturing industry over there. In 2019, we had COP27, where till then there was no consensus in the world regarding whether there is global warming, what should we do about it. But that was the point at which 90% of the world agreed that we need to restrict the increase in temperatures to less than 1.5 degree by 2050. Now, if that is going to be the case, and finally we had regulators, governments, non-government, commercial enterprises, individuals, everyone aligned to the fact that we need to bring the greenhouse gas emissions down. Now, this is what gave the impetus, and this was the trigger that, okay, now a lot of money is going to flow in this direction. Which are the businesses that can benefit out of it? And if I were to lay out the energy transition, it's energy generation, transmission and consumption. And on top of that, of course, there are finances and new technology that will develop. But in energy, there are sources like solar, wind, nuclear, biofuel. In the at the end, in the consumption, there is electrification of everything. We talk about EVs as a trend, but EVs, there is two-wheelers, CVs, three-wheelers, buses. There are many segments. In the power transmission, of course, it's like if you're going to start selling cars, you need to first have the roads in place. Unless we have our power transmission in place, we are not going to be able to transition away from fossil fuels, which is a much more stable source of energy, to renewables, which is far more variable and infrequent.
Sure.
So we need to have power transmission, which is a grid which is far more flexible, efficient, much larger and effective. So this is how we looked at the entire space. And when you saw that, what we realized is, as I mentioned, that a trend can play out over a 20-30 year period, but which is the immediate sector that will benefit.
Correct.
And that's where the power transmission fits in. That we need to build this power grids in the next 7, 8, 10 years for us to ensure that we move towards the renewables. And when you see, this is one space where there is no Chinese competition. There is no Chinese technology. On the power generation side, on the renewable side, it's completely dominated by Chinese. But in the power transmission, it's still all European technologies, and there are very few players in every segment. There are 3, 4, 5 players at max. So you are going to see a big delta in terms of opportunity, and that delta is going to be captured by few companies, and there are some companies that have a right to win over there. And that is our formula for picking any company. And whether it is Hitachi in energy transitions case, and or with disclaimer, of course, we still continue to hold Hitachi. Okay. But above 765 kV, there is only, Hitachi has almost 65-70% kind of a market share in transformers. And when we bought it, of course, the earnings were depressed, and that's why the multiple looked very, very high. A lot of people thought that 100p multiple stock, but essentially, you had to look at, this company is potentially going to get anywhere between 25 and 50,000 crore kinds of order in the next 3-year horizon. Sure. And it is available at a 15,000 crore market cap when we bought it. And where the earnings, margins, everything is subdued. So it was actually a no-brainer to me. Of course, I was still, the execution still remains ahead of us, and we could see further some quarters where the delivery doesn't come through. So always the mind is prepared that if the stock corrects more, we will be buying more instead of getting worried about.
It's a long-term call, so you won't bother about the
5-7 year story that we are talking about, and 1-2 quarters here and there can definitely be an issue.
Just the thing that stands between both of them, and I'm sure is common to all of them, is the sheer hard work that they're doing when it comes to the research. It's very easy to just come out and talk about one of these ideas that have been very successful for all of you all, or the ones which haven't worked. What one can't take away is from you all is the kind of research that he's doing, the macro research that he did on the entire space, the renewable space, or any theme that he's backing, or the fact that you look at each company's quarterly result. That's nearly 5,000 companies, 4 quarters, 20,000 earnings sheets that you're looking at every year. That is something that Vikas spoke about earlier as well. That if you want to make quality returns, you have to do quality work as well, and at the same time you have to be willing to see what no one else is seeing. Be it ICICI Bank in 2019, when no one else was seeing. What was it? So I just want to understand, what is your input that allows you to see what no one else is seeing? Because when you said that, the narrative is a certain thing, whereas the rate of change is something else. Be it ICICI Bank, be it the Atmanirbhar Bharat segment, be it the manufacturing companies, what is it that you saw at that point in time where the narrative was completely against? So can you give us that secret?
No, sure. I think first of all, when you have to take a call against the common narrative, one thing which is required is your conviction and the courage to act on that. Because when you go wrong, you're going against the sort of common narrative. So, and that requires deeper work, deeper understanding of a lot of things. So, one of the things which you always look like, since you referred ICICI Bank, I think everybody said ICICI Bank is a dud, nobody creates. But I think what market missed is a change in the leadership. See, it's a good brand, good balance sheet, good technology platform, a decent, large player. But in every organization, change of leadership brings a new energy, new drive, So what missed was the change of the leadership and what that leadership could achieve in a very short period of time. And when we spent time across various levels of the management, we figured out that there's a very big change in the culture and the strategy which has already taken place, which is not noticed by the market. Market was still going by the narrative, asset quality, still no poor ROE, poor But that change was what goes in, takes time, few quarters to reflect. And when nobody's buying, you are getting right price. So at one time book we bought, it was like I think sub 300 levels. Today, in 5 years time, 2.6. It's, it used to be cheapest stock. Today it is probably most expensive stocks in the banking sector.
Yeah.
And as more and more people figure this out, that leads to re-rating. So one of the big theme which I have is that big money is made when you capture both earnings growth and valuation re-rating.
Right.
That's where you big money, whether to find out an sectoral theme early or a change in the company early, and that is what plays out. But it requires a lot of work connecting the dots. Same way, manufacturing, everybody was common narrative that it can't do well. But when we spoke to 30, 40 companies, everybody in their own way was communicating something different, that something is changing. And we said, government is trying to do, China Plus is working out. We spoke to some consultant, McKinsey kind of people to figure out what's happening globally. And that gives us the confidence that this is here to stay. This is here to stay for a very long time. And when you have something trend which is here to stay for a very long time, then you go all in and you really take sizable bets. You could have bought few stocks, but then the reason why we launched a separate strategy is because our conviction was so high, right? And other thing I would just say that probably money gets made when you stay for a very long time. Another example I would give you, there's typically, many good managements go through bad business cycles.
Yeah.
And in those situations, if you can identify those change in the cycle, like I remember 2012-13, there was a company called KEI. The total market cap was 75 crores. And market had written that company off. But management quality, was great. I mean, I've seen the only company which didn't default in cable industry, despite that bad times and all, and nicely transitioned the company from industrial to consumer side. Market completely missed that. But you know what? If you remain stayed invested, so when I bought it was 75 crore market cap. Today I think it's 35,000 crore market cap. It's only 10, 12 years. And in this period of 10, 12 years, I can tell you many periods of 30% drawdowns have happened. If you don't have conviction around those management and the business quality, in those drawdowns you will give away. But if you have to make supernormal return, those few quarters of bad cycle or industry, you have to withstand. But that requires again conviction in the management and the business model, and that requires work and
you have to apply yourself, absolutely, and look at all the granular, smaller details, which kind of resonates with what Rashi said earlier, right? Look for dislocations.
Yeah.
So Rashi, part A of my question is that typically is that, say, a slightly higher risk strategy than simply playing momentum, simply playing where the numbers are, where the growth is, because it's clean, you can see it right there, right? It lasts till it lasts. So is this a little more evolved for the more sort of complex investor? And then give us examples, because with dislocations, you can be right or you can be horribly wrong. So what kind of dislocations do you see opportunity in?
So I think that's a really good question. And I think what you need to do is break up return, right? So we have a risk neutral position. We have the beta of the market and we have the alpha of the market. So I clearly operate in the alpha portion of the market, which is the mispricing.
Okay.
To me, and correct me if I'm wrong, but I believe the normal growth strategies, the momentum strategies operate in the beta side of what your risk return is. So yes, it is slightly, you have to know your companies extremely well. You have to know when to cut back, because your, theory or investment philosophy in the company is not playing out.
Yeah.
So I'll just give you an example. Back in 2022, when oil hit 130, the last time that it hit 130, I think the general agreement and conviction was that at 130, the world will slow down. At that price, it's just generally not a price that the world can operate at the growth levels.
This is the Ukraine war time.
Yeah. Now, did I expect oil to come down to 75? No, but we were in the, it should come down to between 95 and 100, be a more comfortable space for the world to operate in. Now, that's when we look for which companies go through the highest price dislocation because oil is at 130. So these are all oil ones which use oil as a commodity, right? So whether it's in the airlines,
tires, airlines,
Indigo, Apollo Tires, CNBC. We found the highest price dislocation amongst these companies. We found that at a normalized oil price, the price should be much higher for each of these companies. And if you looked at Apollo Tires, so I remember somebody telling me on the sell side that, it's trading at 40 times earnings. I said, yeah, but there's no E. Right. So that's the key part. You can't look at it for that. And we bought all three. We played it through to when oil was down to 80, and we made our money on it. And again, it sounds like this happens in 3 months. It doesn't, right? It takes 6 to 8 quarters to play out the way you want it to. At the point when we did sell Apollo Tyres, and even today, the P is 13. So from 35 to 13, you've seen the earnings expand per se, and that price dislocation then go back. So, you know, somewhere to what Vikas said, that earnings and then, you know, some kind of re-rating that happens on the stock in this case, is what you're looking for.
Okay, so price dislocation, that's the kind of dislocation you primarily look for.
Well, it's price dislocation because that's when you find the stock price significantly below what you think is the value. So at the peak of COVID, it was Bajaj Finance.
Got it.
Now, it doesn't come in as value because it was still trading at 3.5 times book at 1,900 rupees, but it wasn't trading at 1,800. I mean, sorry, 8 times book.
Right.
And that is price dislocation when it comes to that stock trading relative to its own history.
So it could be a commodity price move, it could be something intrinsic, a bad earning,
Absolutely.
it could be anything.
You know, back in 2012, it was Maruti when the strike happened.
All right, so what we'll do is we'll, you know, just take a very short break on that one. We will come to Roshi as well because everyone's spoken about their story. We'll probably bowl a googly at Roshi and get her view on, you know, what she learned from the investment mistake that you had made, because that is also something that teaches everyone about their investment journey as well. Take a short break, come back, we continue our conversations with the young guns of T Street.
Welcome back to this Diwali special, the young guns of these streets. So you've got a sneak peek into the minds of all of these individuals who are here on the panel. We're trying to get some hacks, some investment ideas in terms of how to think. When you can think right, then you can identify the right fund or the right stock. So now it's time to hear from Roshi. Now, Roshi, tell us again about the thought process. I mean, from what you said earlier, discipline is clearly important. And with that, I want to marry my earlier question of whether it's more restrictive. I mean, all these folks here, maybe they have, you know, a lot more latitude to move around. Maybe they can be more nimble. But when you're in a highly regulated environment like a mutual fund, and that to one of the largest in the country, does that crimp or restrict your style at all?
No, I think it's the way we are perceiving it to be. Mutual funds want you to be wealth creators for your investors, and that's the objective, right? But it just has to be done in an environment where you bring trust among your investors. Each of them said things which actually can be part of a framework. It need not be the same framework, but you have to be consistent about the framework you're following. Mangalam, you asked, you closed by the previous section by saying your mistakes, and I think the biggest mistakes while not naming stocks have been where I've deviated from the framework, because then you lose conviction. So if there was a stock which was in the framework, and even if it was down 10-15%, you would be okay holding it. But when you deviate from that framework and the stock is down 15%, at the point where you should be topping up, you actually exit. That's the difference between having a framework and following it, because then you're able to go through the lows, navigate the lows, and participate in the upside. So I think that would perhaps, I mean, all of what they said is done in the mutual fund universe, by the way. Let's not make it appear that mutual funds are these boring,
boring is great, boring is good.
Non-volatile, regular return kind of products. I mean, active funds have beaten benchmarks in the last 3, 5, 7, 10 years, and not by small sums. One of the things, again, we tend to underestimate is, this fund has beaten the benchmark by 500 basis points over 10 years. Please, that is massive. Please look at your portfolios and see what the difference would be. So I would say that all of this is done in a mutual fund environment as well, just with more checks and balances and with a greater risk management framework in place.
And I must add over here that watch out for mutual funds. Anyway, I will always wave the flag. because it is because of the mutual fund fraternity that we're getting in the 40,000 crores, and the market has been where it has been, right? That's the biggest celebration story for India this time around. And there is a new product, there's a new asset class that mutual funds will launch very, very soon, and you could have more strategies, more sort of stylistic, thematic, perhaps offerings very soon from the mutual fund world.
Add an anecdote to what Roshi was speaking about, restrictions actually being enablers. One of the things that happened when they put brakes and airbags along with seat belts in a car, most of them who wanted to speed said, hey, why do you put a brake? This is so limiting. One person said, no, this is not limiting. This is the one that allows me to speed because there are brakes. If I speed, I know that there are brakes that allows me to go past a certain speed. So, guess who became the fund manager from there?
Absolutely. Discipline is king, right? You can have all the thesis, you can have all the thought process. If you do not apply yourself with discipline, then every strategy perhaps fails. Okay, gentlemen and ladies, we are down to the last, rapid fire, quick. It's the here and now. So an idea in terms of how to put all that you've said, all the sort of intellectual part into practice. So Vikas, starting with you, you are of course rooting for the technology theme. I think you still like the Make in India, Atmanirbhar theme. So a wealth creation tip for the next Samvat and beyond.
I think number one, keep the expectations low. We are coming here on a very, coming back on the back of a great return period. So in this, in my opinion, keeping expectation low is very important because everybody thinks that 20-25% return making is very easy, which probably might not be. So keep that part in mind. Other than that, I think, investing philosophy remains same, but I feel from now to next Samvat, if I were to say, I think financials will do very well because I think that part has not done well in the last 6-8 months, and I can see positivity going there. Pharma, healthcare will continue to do well. IT, we've been positive, and I mean not all the whole pack, but within IT there are lots of interesting ideas where still acceleration growth is happening, 20% growth there. Chemicals is the one space where there are a lot of dislocation. People have written that off, and everybody's seeing China as a threat. But I think 25 would be a great year for them. There are lots of change happening and capacities are coming. So I think CDMO is a great space from a wealth creation from the next 5-10 years perspective. CDMO, CRO is where IT was in mid-90s. So I think there are enough and more opportunities. But I think from this Samvat to next Samvat, these are some of the sectors which can do well. But again, I would say. Biggest risk is the risk of high expectation.
Okay. And tone down expectations, so no 96% next year, maybe 95%. Where does that come from? Tell us. Next Samvat, what are you backing?
No, I would keep betting on growth, but I manage my risk really well. So you have to manage your risk. If things don't play out, if thesis
We have financials. What else do we have?
Financials and chemicals, he said. What else are you looking for?
No, all I'm saying that manage your risk. If things don't play out, if a thesis goes wrong, do manage your risk. Next year will be a very narrow market. Not everything will make money. Only a few winners.
So what will grow at 50% next year?
A lot of companies are the ones which I'm holding.
All right.
Okay. Ravi, your tip?
No, I think renewables is one theme which people are underestimating, the kind of S-curve adoption that can happen over here. And the entire value chain, it's not only about the solar module manufacturer, but the somebody supplying an aluminum mounting structure or EPC work, or everything is going to explode over the next 3, 4, 5 years. So valuations will look expensive. They are expensive. I'm not saying they are not, but if you have a long enough horizon, you'll see that they probably still made sense. Just to give you an anecdotal evidence, in 95, 96 also you would have found IT stocks to be very, very expensive. But if you are in the middle of a major boom, the absolute valuations are still going to go far higher than here.
Okay.
The 2 R's, risk and return. Let's call it Rashi and Roshi.
I actually am hoping for a very narrow market, right? So for price dislocation, I would love to see some correction and a narrow market. And that is what provides me the opportunity to...
Where are the dislocations right now?
Took my question.
I mean, I hope both of them are right, and I'm squarely in that camp as well, where I do not believe that after this kind of run, we can expect another 25-30% of the market. I do think we will be in a very narrow range, and it should give good stock picking opportunities, and that's what I'm waiting for.
Do you see dislocations now? I mean, I don't want to get too specific.
You do.
But for instance, I mean, some of these gas stocks, right? They've fallen off a cliff because of regulatory issues.
So
how much gas allocation?
I mean, a year ago, last Diwali, dislocation was life insurance companies.
Oh, yes.
right? In a market that was even high back then, but people were not willing to look at it.
Yes.
2 years ago, the two-wheeler companies, the larger two-wheeler companies, I do believe the large private sector banks are at a place where the field is actually in favor for them. And
Okay, so we have financials, private sector banks, chemicals and renewables, or manufacturing renewables.
It's easy for me. Just stay diversified. You've got all the sectors from them. So all you need to do is create a diversified portfolio and it will do well.
I think
I'll only end with this. I think India gives you the advantage of being in some world-class companies in a very diversified manner. Look around our peers. They are all so sector-specific. So I would move away from this narrative-based investing to a more diversified business model-based investing, and I think it will work wonders.
I think her message every Samvat is mutual fund sahi hai.
Mutual fund sahi hai, absolutely. Okay, very quickly, I think we've got 30 seconds left on the chat. The mistake to avoid, because we are in a slightly different market now. So I think Vikas mentioned that. Keep your expectations. I mean, if you're thinking 30%, that's a mistake. The mistake you would want to avoid, Amit.
Cut your losers. If you have, if you cannot average your loser down, never ever do that. You need to know when to cut losers.
Don't trust a management that has not acted in favor of minority shareholders.
Lovely.
Okay,
That's a very nice one.
Great one.
Don't buy stocks where you don't understand why they are going up or going down. Understand and know your stocks before you invest in them.
Okay. Stick to your discipline, stick to your philosophy, and don't, style deviation is always the death nail.
You have a new one? He's itching to say something.
And avoid FOMO.
Avoid FOMO. That's I think it's a brilliant way to end. I mean, I think FOMO can be the, the mother or the father or the brother or the sister of all evils. And this Diwali, we need to keep the evil away. So these are the mistakes to avoid. Thank you so much, ladies and gentlemen. It's been a very, very enriching conversation. Very helpful, and I think our viewers will go back, take a lot from this, they'll chew over it, and I think it'll help make them wiser decisions.
Chew over this while chewing over all the Diwali munchies that they are having. May you have a cracker of a Diwali with your loved ones, your family, not just this one, the next one as well. And by the time we return the next time, maybe on those low expectations, you actually make a very high return as well. Thank you so much for watching.
Happy Diwali.
From Surbi, me, all of us, a very happy Diwali.